Welcome to Principles of Accounting. I'm going to take some time out today to go over normal balances. It's important for you to know and remember the rules on normal balances so that you can do your journal entries. And what journal entries are used for in accounting, we use the journal entries to input the business transactions into the accounting system so that we can produce financial statements. So that's why it's important to know the normal balances of accounts so that you can do your journal entry, so that you can produce your financial statements, so that you can give these financial statements to your internal or external users to make decisions. Okay, so here we are. So how do we know whether an account increases or decreases with the debits? And we know that by learning the rules of debit and credit. So assets are increased with the debit. Some examples of assets is cash, land, equipment, accounts receivable. We learned about accounts receivable in the last video. If you have not checked it out, go back, check it out. We learned liabilities that are increased with the credit and equity that is increased with the credit. And we talked about some different liability accounts and some different equity accounts in the last video as well. So if you have not noticed, this is just the accounting equation. Our assets equals liabilities plus equity. And like I said, I explained this in great detail in the last video. So assets equals liabilities plus equity. Assets increase with the debit and liabilities and equities increase with the credit. A little bit. So in order for us to understand the normal balances of our income statement accounts, we have to think of the effect that these income statement accounts have on our equity. So we know that equity is increased with the credit. So our income statement accounts, which is revenue and expenses. Now our revenues increase equity, so it will also increase with the credit. Now our expenses decrease equity, so it will increase with the debits. Let's go over some examples of some assets. Assets are resources owned by the business entity, such as cash, supplies, intangible assets, such as patent rights, copyrights, trademarks. We will talk about those at the end of the semester. Accounts receivable. Accounts receivable is when someone comes and purchases something from us and do not pay at that time. They're going to pay us later. And then we have prepaid expenses, which is also an asset. And what a prepaid expense is just an expense that we have not incurred yet, but we've already paid for it. So we paid it in advance. Sometimes you'll see prepaid expense with insurance when you will pay a whole year's worth of insurance and you have not incurred that whole year's worth of insurance that day that you paid it. So it's a prepaid expense. And we'll go over that shortly. And then we have buildings and equipment are all examples of assets. Equals liabilities plus owner's equity. That is our accounting equation. Our assets live on the left side of the equation. The assets live on the debit side of the equation. So to make the assets increase, we'll put that number on the debit side. To make the assets decrease, we'll put the number on the credit side. An asset balance should normally end up on the debit side. So once you finish with all of your business transactions at the end of the period, you should have a balance on the debit side or a debit balance in assets. Liabilities. Liabilities are debts owed to outsiders or creditors. So this is when we owe someone. As the business, we owe someone else. So we have went and we purchased supplies and we did not pay for it at that time because we're going to pay for it later. Then we have a liability. Okay, so some examples of some liabilities are accounts payable, notes payable, wages payable, and unearned revenue. What unearned revenue is cash received from customers before the service have been delivered. Because as you know, In accounting, we cannot recognize revenue until we perform the service or deliver the product to the customer. So if we receive cash in advance before we have done our part, it is considered unearned revenue, which is a liability because we still owe them that service. We still owe them that product that we need to deliver. So that's why it's considered an unearned revenue. Back to our accounting equation, assets equals liabilities plus equity. Our liabilities live on the right side of the equation. Liabilities live on the credit side of the equation. To make liabilities increase, we put the number on the credit side. To make liabilities decrease, we put the number on the debit side. A liability balance should normally end up on the credit side. So once we finish making all of our business transaction journal entries for that month, when we look at a liability account, it should have a credit balance. Equity is the stockholders' rights to the assets of the business. Stockholders' equity is represented by the balance of common stock and retained earnings accounts. A dividends account represents distribution of earnings to the stockholders. So I'm going to break this down a little bit. So our stockholders' equity, it holds our common stock. And what our common stock is for like a corporation when they issue stocks, or in the example in the last video, we had a young man invest, I think it was $250,000 into a corporation, and he received common stocks because it was a corporation. So that's what common stock is. This is just the owner's invested portion that they put into the business. And retained earnings is the earnings that remain within the business. So what retained earnings is our revenues, expenses, and its dividends. Okay, so this is just simply our earnings that remain within the business. And then what a dividend is, it's just a payout to those stockholders. So this is just their payout. It's just a distribution. So stockholders' equity. Our assets equals liabilities plus owner's equity, the same account equation that we've been going over. The stockholders live on the stockholders' equity lives on the right side of the equation. Stockholders' equity lives on the credit side of the equation. To make stockholders' equity increase, we put the number on the credit side. To make stockholders' equity decrease, we put the number on the debit side. The stockholders' equity balance should normally end up on the credit side. The stockholders' equity lives on the credit or the right side of the equation, and common stock increases stockholder equity, but dividends decrease stockholders' equity. So common stock is when that stockholder is putting money into the business, they're investing money into the business to get these shares of stock. Dividends is when they're getting a payout. So that's going to decrease our equity. So that means dividends will work opposites of capital stock. To make dividends increase, we'll put the number on the debit side. To make dividends decrease, we'll put the number on the credit side. Dividends balance should normally end up on the debit side. Now let's look at revenues. So revenues are increases in assets and stockholders' equity as a result of selling services or products to customers. Some examples of revenues include fees earned, fares earned, commission revenue, and rent revenue. In this class, you will see revenue referred to as fees earned. We'll also work with some rent revenue. And then once we move on to merchandising businesses, you will see sales. All of those are different types of revenues, okay? So what we were talking about, stockholders' equity live on the credit or right side of the equation. Fees earned is part of the stockholders' equity, but it lives on the right side as well because revenue increases stockholders' equity. So anytime the business receives revenue, that increases the stockholders' equity. Fees earned is a plus item and work just like capital stock. To make fees earned increase, we're going to put the number on the credit side. To make fees earned decrease, we're going to put the number on the debit side. To expenses, because it will work opposite of our revenues. So our expenses is results from using up assets or consuming services in the process of generating revenue. Some examples of expenses is wages expense, rent expense, utility expense, supplies expense, miscellaneous expense. As a given, you will see expense behind whichever type of expense it is, and that's how you'll know that it is an expense. Stockholders' equity live on the right/credit side of the equation. All expenses are a part of stockholders' equity, but it decreases stockholders' equity. So all expenses work opposite of capital stock and opposite of our revenue. So to make expenses increase, we're going to put the number on the debit side. To make expenses decrease, we're going to put the number on the credit side.